All right, so the analysis is based upon today's close, and if there was a time for the bulls to really make sure we go sideways for this month, it was today. The fact that, I mean, it's still kind of up in the air because it's been going sideways, but the fact that the bulls failed is not a good thing today. Because then there's more. It's a signal that there's more momentum to the downside than expected. Now, if we go over the fundamentals of the risk on, risk off fundamentals, we're going to open that up and then go ahead and talk about the macro too. Sorry if I clear my throat too much. I got out sinuses. It's draining. It's really not pleasant. So, yield curve over 74% inverted. So it's pretty high. So don't be surprised to see all the inversions on the yield curve. I mean, we're inverted in the Euro-dollar futures all the way up until June 2023. So I don't know if that has any big significance. The big significance here is that we're expecting a big recession in 2024, 2025, that area. Or beginning of 2024. But that's what it's saying. And it lines up with the average recession when it comes to 3-month, 10-year inverted, 2-year, 10-year inverted, and just the average recession after when they invert. Roughly, I think here in my index, I indicate those time periods. So macro fundamentals, risk on, risk off in fundamental. So it says here from the 2 and 10, it's roughly 6 to 24 months before recession. So in the 2-year, in the 10-year inverted, there was 6 to 24 months. So if it inverted in Q1 this year, 2024 makes sense. And then the 3-month, 10-year is 6 to 18 months. So this inverted roughly within the last month or two. So, 18 months from now, so minus 2 months, so 10 October. So then roughly 6 months from October would put us in 2023, roughly I don't know, June, July, maybe a little bit before, and then 18, so it seems right about the sweet spot of the what this Euro-dollar futures is saying. So that big recession expect to happen around there. Now, a touch to the lows here, the target is roughly down here around 30, 33, so roughly a 15% drop I still think is possible. I don't know if that would count as a recession, but maybe another bear rally or a bear move I think is possible. We're gonna go over the fundamentals really quick. Oh my gosh, I didn't open it. There it is. It is open. What is this? So this is reverse repo. Basically, the banks are scared. The higher this is 2018, right before 2019, right before the COVID nuke, and here we're again scared again. SOFR is related to the banks minus reverse repo. It's a not like a zero spread, and then minus the 10-year against reverse repo, it's a negative spread. So people are paying a premium to get reverse repo versus pay for the 10-year because they don't have a good outlook on the economy right now. And this is against the 2-year. And right now, it's even. Like, I mean, 2016 through 2018, we were above this line, and then once we got below, it was 2019, and then 2020. So I think this purple line is like the best kind of estimate as to healthy versus not healthy in comparison to the 2-year. Euro USD, so this is the foreign exchange. We're in the upper bound. We still got 22 days left, but this could totally flip. We look here at the Euro index. These order blocks are right behind it. It's questionable if it's going to continue. We're here at weekly resistance, and if we don't close the week above and we close the week below, I mean, we've already tested it this week. And if we get a rejection, we'll see an about face, just like what happened with gold. Gold, from when I announced it way back, that I would not, even though we had a market structure break to the downside to the upside in gold on the weekly, I was just not interested in it because it just did not look like it was ready yet. And specifically, let me get it so that it's a little clearer. I said this up candle weekly close, if it didn't close the week above it, I'm not interested. I said it was still premature, even though we had a nice setup, a really nice scoop for a bull, like good risk to the upside. Unless we close the week above, I'm not interested because it's weekly resistance, and look and behold what happened. We pretty much about faced there. Now, a lot of people who love this asset class and have a bias towards it, like in the short term, it's not good to have a bias. You just want to be objective for the most part, and the bias would actually make you lose money in the short term. In the long term, like if you are just bullish overall, stagflation is coming, yeah, like I believe in that too, but I also have interest in the short term, like just because I trade, and it's in my interest to know on what to look for in the short term. And I'm bullish on gold until as long as it pulls back. I'm thinking everything will pull back for the most part, except like the yen or bonds, maybe long-term bonds. Like the Fed is basically making everything gonna go down. If all commodities, oil looks weak, if all of lumber is weak, if gold becomes weak, nothing is safe. Basically, for the most part, Japanese yen will be safe because it's been so neglected. It's been sold so much. It's so cheap, so it makes sense. The energy, the money, the liquidity will go into yen. It's the cheapest thing there. So this weekly close is really important. If we get another weekly close where we fail, we don't close above, which is highly likely because there's no news. So what's going to push up the market? Nothing. We could take a look at Forex Factory and see what the calendar says, but all the news is next week. We got CPI next week. We got that's the Fed funds is next week. So that's the biggest thing to me. So this week, unemployment claims, PPI. That's it. Not really high impact news. Now Wednesday, Fed funds. That's high impact. CPI Tuesday, high impact. So to me, it just means if we go sideways, or if we basically stay the same in gold, in oil, in the market, and we have a weekly close where we're at, it's not good enough. We need that weekly close above in order for the bulls to really scale in. If anything, this Wednesday is it's set up for going down. If you want to get an experiment of the upcoming Fed funds, we go to so this is the Fed funds, 3.78. That's where we're at, and then we take the forward yield. The forward yield is betting on 4.87. So we have 1.09 to go. Fed funds minus the forward yield. And then the 2-year. The 2-year believes that we got 0.48. So they're thinking another a 50 at least 50 point hike. So, if anything, we're still going to go up 50 points. Maybe not reach 4.7, but hey, like 50 basis points is still big, and I don't know if it has to do with what's expected versus what's not expected. I don't know, but another notch up doesn't make it more useful. It doesn't make it better to where it's bullish all of a sudden. And if we also took into account maybe using the speculators for the Eurodollar futures is similar to what the forward yield is saying, around 5. So this is saying 5.08, and then forward yield 4.8. So it's roughly 0.2 away from each other. So a lot of speculators saying that we're gonna keep on raising the rate hikes higher for longer. That's what the message says. So that's that. NFCI, we're back in the gray box. We go below the gray box, we're back in the gray box, but basically it means that there's too much risk, not enough credit, and what is this? Not enough liquidity. I guess that's credit. There's another one. But anyways, the shadow banking system, it looks fragile. Basically, anytime it's in the gray box, it's fragile. Consumer sentiment has been low. So we might as well put XLY divided by XLP up here. Move it up because there it is. Because consumer sentiment just looks terrible. I mean, let's go ahead and look at it through this lens. Look at that. XLY discretionary versus consumer staples. It's crazy. Like, it's dropping like a rock. And if anything, this is signaling, we've heard about the retail sales for Target, for Amazon, and the Black Friday numbers have probably come out, and it just probably looks terrible. Like, why else would it look like this, where discretionary is losing against consumer staples? Like, it's because there's a lot of fear. There's a lot of demand destruction. So it is hard to try to discern, like, where's the bottom touch going to be? Is it going to be this month, or is it going to be in January? Like, it's really hard to discern between those two dates. But I mean, for how bad the data looks in consumer sentiment and just how it's really come in and come through, it makes it hard not to believe it's going to happen this month. And we're going to get into a breakdown. Timing solutions, money flow index, momentum, and market structure. And just really supporting the claim, or at least dissuading the claim that it's going to happen in January. And obviously it's the best guess. It's not knowable. I would say it's even more unknowable now than it is until we reached the Fed funds rate and the CPI date. So, pressing forward, manufacturing production minus inventory, high inventory, low production. So more of a reason to lay off people. Inversion to the beyond 2018, 2019 inversion on the 3-month, 10-year We're inverted on the 5-year, 30-year, 2 and 10 beyond '08 levels. There's '08 levels of inversion. Beyond it, we're inverted. So crazy. Now the credit spreads. This one is the one that we're dependent upon, and this and the oil is what I would be watching. Now we still have this gap to fill, and it's questionable when is that going to be. And I think with closing below support here on the week, I think if we close below support here, I want to set an alert. We want it less than bar close HYGH credit spreads, high yield growth credit spreads, breakout on the week. Close below weekly support right there. That kind of break will signal we're going to fill that gap and fill this gap. It's going to be momentum, and it's more likely to be this month that we will probably have the touch to the bottom versus Q1 2024. So credit spreads is a big indicator. So this one's a little harder to discern support, because technically the only down candle we have is the weekly, but we have a gap down here that's going to want to fill. So I don't know. I think we'll just mark up HYGH and just call it, and we'll expect that corporate long-term bonds follow the same suit as the high yield growth. That they're in sync with each other. We only need to mark up one because they're in sync with each other. And if we have a breakout in one, we'll have a breakout in the other. So we're basically gonna not touch this because there's not a whole lot of data. Just assume that it's gonna do an about face, just the same thing as this high yield growth. But credit spreads don't look that good. I mean, there's fragility here. I mean, we're crossing below the moving average channel. Lower high closes on the up candle close. This did a failed breakout here. Now we're rejecting, and we're breaking below weekly support. So we need to see how the week closes on this. But this weekly close on this high growth credit spreads is a tell for me. You know, there's not a whole lot that's a tell out there on the fundamentals, but for a near-term swing, and for a near-term swing, we want to look at credit spreads. Credit spreads is the thing. The economy runs on credit, and if credit spreads are non-existent, no one wants to lend, people are losing, then we want to hear about it. And credit spreads and oil are the things to watch for. Gold will follow the market and risk-off sentiment. You know, so if the market looks weak, gold will be weak. It's that simple. Gold is not immune to downward moves in the market. It's also sensitive. You know, gold is, I think, great for stagflation, but you need the market to be going sideways or going up in order for gold to really be in the environment to thrive, because there needs some stability to exist. All right, lumber. Lumber looks pretty bad. It's weak. No one, construction. This is lumber versus gold. Before around 2018, we got closed below this moving average channel until we hit 2020. We're doing it again, and it's a matter of time, and before it capitulates. But we got the signal, like, things are risk off right now. Base metals versus precious metals, I don't know, like, really, we're in a consolidation, and it's just hard to discern what we're looking for. If anything, we're looking for maybe a higher close above here, and then another one, I guess, right there. These are swing lows. But maybe, we can mark out support resistance. So support on the 6 month will be there. Resistance on the 6 month will be here. So we want to see a breakout above or below, and it matches the last year high. So that's kind of what we're looking for. I guess we could set alerts there too. We want on a bar close crossing. Continue. We want less than. We want greater than. And then copper versus gold. I don't know. Like, I don't know how to read this right now. It's just choppy. That's all I could say. So here's another one with the credit spreads. We might as well just put it up here. So junk bonds versus TLT. Now this one, the best way we could deduce what's happening is the cross below the last quarter high. We went ahead and went below this moving average channel. If we were to change it to the monthly, I mean, I don't know. It's hard to discern really what's going on. I mean, there's a swing low here. It caught support. Now, I would say here's a swing high. If we were to stay underneath that, that's bad. That's the best I got. And that happens to be right where the weekly market structure break happened to the upside. And if it breaks to the downside, then it's bad. And so we'll call this swing high. So that's where we're betting that there'll be resistance, and that as the longer it stays below here, the more downside there is to credit, and people will flee to safety in long-term treasuries. And yeah, I mean, it makes sense. Technically, it'd be nice if we could just move it up here. Yeah, there we go. We relock it. Let's see where that's at. Yeah, just across those wick highs. So that makes sense to me. If totally sell off this wick, huge risk off move. I don't know how much percent that is on that wick. That's a lot. And then it happens to be also we're under this moving average channel high, and we're staying bearish, and growth is not on the table right now, and we're going back to test the last year low, maybe, or at least now we got the last year high. See if we get rejected there in terms of risk off sentiment. And we're below the 6 month swing high. So look at that. Now 6 month support roughly right here. So we expect price to go back to the 6 month support. And so it means further downside. On credit in that moving average channel, that looks really nice. So lumber versus gold, we already saw that. Move index, its risk off indication is pretty much expired. 2019 or 2020 COVID nuke high, we got really close to it. But that's basically the fundamental risk on, risk off. And as you could see, like it doesn't seem so like heartsy and full of hope for this December. If anything, it needs it to flush out the inevitable. the inevitable is that the credit is weak and demand destruction is high. Everybody's fleeing to safety, whether it's the banks, whether it's businesses, whether it's consumers, and credit. It's very all of it's saying risk off, in lumber versus gold, construction, and in terms of like junk bonds versus long-term treasuries. It's all of it is basically saying risk off. So it doesn't seem very, very hopeful, and it makes you arrive to the conclusion, okay, we're going for another leg down. It's very likely we're going to have a 15 to 20% drop. Okay, when is it going to be? That's kind of where it places you in the conclusion of. And that kind of brings us to the get rid of this, the trade plan. So the question is, okay, is the bottom going to be put in December or Q1 2023? So, starting with timing solutions, this acknowledges only reversals and acknowledges the two places when we could be putting in a top. So, in decennial, there's like two peaks, and that's basically the two areas where I expect for us to reverse and possibly make our way to the bottom. So we got one that is currently in style, or in right now, like it's current, and that's pretty much 1208 going into 1214. So you could look at that and be like, okay, it sounds like 1214 will no more, and it's possibly bottom, and then it looks like 1229 we start to rally up in some way. I don't know. And then it looks like more further downside. So the decennial is interesting because it changes a lot. But if we look at the annual or the 4-year, we can get a better idea of maybe what to expect for the future, because they don't change a whole lot. I know the annual does a little bit with the decennial, but I don't know. Like if we use the 4-year as an example, it looks like that's probably what we might expect. Is that maybe, I don't know. We'll find out near the 14th or 15th. How, if we're going to reach it then or not, and then play by ear maybe in the beginning of January, the very first month of the year. It's just hard to believe that it would happen in January. Oops. Okay, so this doesn't give us enough information. Now we go to money flow index. So money flow index is about the institutional money. So institutions, they were bearish, and now it looks like they are at 39. So I think anything 35 and above, roughly right here, is not a clear signal. So right now, I think we're just waiting until the Fed funds next week. That's basically, there's not enough clear signal for the institutions to really be positioned. So that is not useful for getting to a clearer decision. So neither timing solutions or money flow index gives us a clear, it's just telling us to pretty much deduce, pick one. And then momentum and market structure is what's left. So if we look at momentum, we're using the indicator called MACD with the settings. It's custom 31016. So my kind of assessment is, if we do not see the bulls step in within this week or up to the first or second day of next week, this will continue. The bears will continue to bleed this to where the momentum is too great to, and then we cross to the downside. And then, as you can see, with every cross on momentum on the weekly is the strong impulse that happens. And this is the last one that is on the upside. Daily's on the downside. H4 is on the upside. But the thing is, with it being on the upside of the H4, with no market structure break on the H4, it's bad. It means that the bulls are struggling. So the more struggling that the bulls have in this weekly close, going into next week, the more likely it's going to be this month in December where we touch the bottom. That's my argument. It's very conditional. If the bulls struggle this up into the Fed funds, it's going to be this month. And I'm pretty certain with that so far that that's like a really good thing to hold to with the momentum. So it's right now the H1 and H4 have crossed up. Now it's about to cross down here. But we have to see how the weekly closes. But I'm guessing that we close lower on the week. I'm guessing we close down here. We have a naked breaker with a naked pivot, and if we close the week down here, and we ended up closing below this moving average channel, it's pretty self-evident to me that it's going to continue lower, and it's going to be this month. So that's kind of, it gets clearer on the technicals and the momentum of what to expect. Now, the opposite is true as well, that if the momentum holds strong and we just go sideways, then it's more likely that it's going to be next month. But it's just so close together, whether it's January 7th or mid-December, they're just too close together to really make any real difference of when it's going to be. If you're a long-term investor, does it really matter if it's 20 days apart? Right. Next is market structure. So we haven't had any market structure breaks to the upside today. If anything, right now we're threatening. Let's see. Is there? I thought there was like a daily order block, bullish order block. Oh no, we broke it. We broke the daily. Okay, so that's what I wanted to show. So we broke the daily bullish order block on S&P 500. And that's the last, as long as there's no weekly bullish order block, there's the last one that was strong was the daily, which is this one. And it broke to the downside. So out of the H4, there's a H4 bearish order block. As long as that stays bearish and it doesn't turn into a breaker, the more likely we're going down. And we need to see how the week closes, but it's not looking good. It looks like it's stronger to the downside. Risk to reward, it makes sense to go for the upside, but in terms of momentum, and there's a divergence. It's more to the downside. The force is more to the downside. And we did break the H1 to the upside, but it failed. And it's not looking good. If anything, soon that H1 MACD and this H4 will cross down together and bring the momentum to the downside. So I'm proposing that as long as H4 as momentum to the downside continues, the more downside there will be with the ultimately leading to a weekly MACD cross 31016. And then here's another point, is where we closed on the day. So daily support is this last candle that's bought these wicks here up until 2 days ago. We closed below, we retested, and it got rejected. We're under the 24 moving average, and we're at the indecision point at the 150. And the main thing to look at is this daily flip from support to resistance. And it means we got a while's, like, we got all the way till here for any real support. That's daily demand. So if we close the week down here, it's more likely that it's going to be in this month than January, because we broke out, we retested, we resumed. Like that's how the pattern goes. It's looking for liquidity, and the next zone of liquidity is here, is this daily demand. It's looking for demand where it's going to support it, and unless we close the day above here, it's not going back up there. If anything, this is going to be the new resistance point. And or if anything, like it might be here with the swing high. I don't know. I'm just saying from the daily standpoint, it's just not looking good. You know, we broke out, we retested, and it's time to resume. And the lower we go, the worse the outlook for us to stay sideways until January. So so this is point one, is the momentum is negative. Point two is that we had a daily close below support. So we're no longer at support anymore, we're at resistance. You know, the chance for the bulls was today, or Wednesday, the 7th, to really get back above, and it almost looked like we did. I mean, that's kind of why this H1 broke to the upside, but it turned around. It did an about face, and now it's over. And the bulls are weak, with weak bullish presence to resume down for liquidity. And then I think that's about it for market structure. You know, we broke the daily. Let's go ahead. What's weird is like it doesn't show a daily order block here. I don't know why that is. I mean, it's the exact same. So this was H4. So I expect it to go down into daily demand and then bounce from that. There's a naked H4 breaker right here. It's basically the same area, 37.97, where daily demand would be. So if we turn this to daily, drew the daily demand, we were to sync it, it's basically in the same spot. It's going to head towards this H4 breaker, and then it's going to come back next week, CPI reading, and test up here, and this daily SR flip for a retest, and we're going to find out then it's going to get rejected. But the fact that we could close the week down here is not good. It's not good. It's just too much momentum to the downside. So that's my argument, is that the momentum and the weekly close, our market structure, will really reveal the weekly close. Will give the biggest tell for Fed funds week on lean, on bullish or bearish lean. I mean, that's the best I got. With every daily, weekly close, we get more and more data to confirm the lean of the spectrum, which way is more likely. And what I've proposed so far, fundamentally, risk on, risk off, looking at timing solutions and money flow index and momentum and market structure, that it's more likely that it's going to be this month. And with every weekly close we get, we can get an adjustment of the thesis. But so far, it doesn't look good if we were to continue more downside throughout this week and we close the week lower. So the question is, like, where would be so a weekly close. So this is the daily SR flip right here, and we want to move that over here. Now, if we close the week below this weekly support, that's a breakout, and more likely this is going to be weekly resistance. So this daily SR flip, and we get a weekly SR flip, it's just a lot of resistance right there. Weekly and daily SR flip, they're right next to each other. If they flip, we get resistance here. It's going to want to break it down. So we got a daily SR flip. We're about to figure out if we get a weekly SR flip. So we got a daily close and then weekly close SR flip will be another point towards the bears. Slash bottom happening this December. Hell before Christmas. So that's basically it. If I were to just lay out the trade plan for the case for the bottom happening this December as opposed to Q1 2023. I've been hearing a lot of 2023. The first quarter of 2023 as the bottom, and we might go sideways for into Q3 2023, but I think the bottom will begin. The move to the bottom will be in December, and then we go sideways and consolidate in base, up into, I don't know, end of February, beginning of March, we head up. And that's the thesis so far that I could see based upon timing solutions, money flow index, momentum, and market structure.